It's risky to buy a stock outright ahead of its quarterly earnings report. Disappointing results or guidance can damage even the best-looking stock charts. But just because earnings reports present an added risk, that doesn't mean investors can't benefit when a stock gaps up on earnings. Now, it's key to keep an eye on stocks that are setting up ahead of their quarterly reports so you can be ready to strike if and when they surge higher on their results. If you see a top growth stock breaking out after its report, that's a buying opportunity. And even if we see a breakaway gap and shares become extended from that standard 5% buy zone, it's still a chance to buy. Now, we normally say that buying a stock when it's more than 5% above a proper buy point would be considered chasing a stock. Even though buying on a breakaway gap might seem counterintuitive, our research shows that this action is often the precursor to further gains, so it's an exception to that 5% buy zone rule. In the case of a breakaway earnings gap, investors should look at an intraday chart and see if that first 5-minute bar looks strong. That's your signal to buy. It would also be ideal to see the stock close in the upper half of its trading range for the day. That's a sign of strength. Okay, so let's take a look at the chart of chipmaker Xilinx to see the breakaway earnings gap in action. Heading into its Q4 report in January 2019, Xilinx was working on a consolidation with a 95.28 buy point. Earnings and sales were strong and had shown accelerating growth for several quarters. After Xilinx posted even greater acceleration of growth, the stock gapped out of a base in heavy volume. Now, looking at the intraday chart for Xilinx, the first 5-minute bar was strong, and that's your signal to buy shares. Xilinx closed the session near the top of its range for the day with an 18% gain. That's very bullish action. Now, look what happened from there. The stock went on a run, gaining more than 30% over the next 3 months. It's a great example of how a bullish earnings gap can lead to even more gains. But the chipmaker's chart also shows us the risk associated with holding a stock into earnings. Shares gapped down 17% after issuing Q1 results in April 2019. That's where selling strategies come into play. If you're sitting on a sizable gain headed into earnings, you have several options. Sell your entire position, sell part of your position, or hold. Now, if you hold a stock that ends up gapping down, make sure you're quick to act on sell signals.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.